China's gold buying spree could trigger a $4,200 profit opportunity. China's been buying gold at a record pace, and analysts say it's a sign of a comeback. But what does this mean for your investments? We'll break down the numbers and explore how China's gold buying spree could impact your portfolio. China has been buying gold at a record pace, with $1.4 billion in gold purchases in the last quarter alone. This is a significant increase from the $800 million in gold purchases during the same period last year. And it's not just China. Other central banks, like Russia and Turkey, are also increasing their gold reserves. In fact, central banks have bought a total of $15.7 billion in gold in the last year, up from $4.1 billion in the previous year. But what's driving this surge in gold buying? And how could it impact gold prices? For instance, the People's Bank of China has been increasing its gold reserves, with a notable purchase of 100 tons of gold in 2019. Back in 2013, China's gold reserves were estimated to be around 1,000 tons, but now they are estimated to be over 2,000 tons. This significant increase in gold reserves could have a substantial impact on the global gold market, potentially leading to higher gold prices. Furthermore, the gold buying spree is not limited to central banks, as individual investors and institutions are also increasing their gold holdings. For example, the SPDR Gold Shares ETF has seen a significant increase in its holdings, with over $50 billion in assets under management. Additionally, a notable example is the purchase of $500 million in gold by the Hungarian Central Bank in 2018, which marked a significant increase in its gold reserves. Historically, central banks have used gold as a hedge against economic uncertainty, and it seems that this trend is continuing. The increased demand for gold from central banks could drive up gold prices. In fact, gold prices have already risen by 10% in the last year, from $1,300 to $1,430 per ounce. And some analysts predict that gold prices could reach $1,600 per ounce by the end of the year. But others argue that the gold market is volatile and that prices could drop just as quickly. For example, in 2013, gold prices plummeted by 28% in just 6 months. However, it's worth noting that the current gold market is different from 2013, with a stronger global economy and a higher demand for gold. Additionally, the gold market is not just driven by central banks, but also by individual investors and institutions. For instance, the gold market has seen a significant increase in demand from investors in Asia, particularly in China and India. Historically, gold has been a safe haven asset, and its price has tended to rise during times of economic uncertainty. With the current global economic landscape, it's likely that gold prices will continue to rise, potentially reaching new highs. Moreover, a common misconception about gold is that it's only a hedge against inflation, but it's also a hedge against currency devaluation and geopolitical risks. For example, during the 2008 financial crisis, gold prices rose by over 20%, while the S&P 500 fell by over 30%. This highlights the potential of gold as a hedge against economic uncertainty. But the part that surprised me most is how China's gold buying spree could impact your 401k. That's next. You'll learn how to protect your retirement portfolio from potential market downturns and how to take advantage of the gold market's potential upside. For instance, you'll discover how a simple allocation to gold can reduce your portfolio's volatility and increase its returns. China's gold buying spree could have a significant impact on your portfolio, especially if you have investments in gold or gold-related assets. For example, if you have a gold ETF, you could see a significant increase in value if gold prices rise. But if you have a 401k or other retirement account, you may want to consider diversifying your portfolio to include gold or other precious metals. In fact, a study by the World Gold Council found that a portfolio with a 5% allocation to gold can reduce volatility by 3.2% and increase returns by 1.2%. So, how can you diversify your portfolio to take advantage of China's gold buying spree? One way is to invest in gold mining stocks, such as Barrick Gold or Newmont Gold Corp, which have seen significant gains in the last year. Another way is to invest in gold-related ETFs, such as the VanEck Vectors Gold Miners ETF, which tracks the performance of gold mining stocks. Additionally, you can consider investing in other precious metals, such as silver or platinum, which have also seen significant gains in the last year. Back in 2008, during the financial crisis, gold prices rose by over 20%, while the S&P 500 fell by over 30%. This highlights the importance of diversifying your portfolio with gold or other precious metals to protect against market downturns. Furthermore, a notable example is the performance of the gold mining stock, Franco-Nevada, which has seen a significant increase in its stock price in the last year, driven by the increase in gold prices. But what if I told you that there's a way to profit from China's gold buying spree without actually buying gold? That's right, and it's what we'll cover next. You'll learn about alternative investment opportunities that can help you take advantage of the gold market's potential upside without directly investing in gold. For example, you'll discover how investing in gold-related companies, such as gold refineries or gold trading companies, can provide a significant return on investment. If you're not interested in buying gold directly, there are other ways to profit from China's gold buying spree. For example, you could invest in gold mining stocks or gold-related ETFs. In fact, some gold mining stocks have seen significant gains in the last year, with one stock rising by 50% in just 6 months. Alternatively, you could consider investing in other precious metals, like silver or platinum. For instance, the silver price has risen by over 20% in the last year, driven by increased demand from the solar and electronics industries. Historically, silver has been a more volatile metal than gold, but it has also tended to outperform gold during times of economic growth. Additionally, you could consider investing in gold-related companies, such as gold refineries or gold trading companies. These companies have seen significant gains in the last year, driven by the increase in gold demand from central banks and individual investors. Furthermore, you could consider investing in gold-related indices, such as the NYSE Arca Gold Bugs Index, which tracks the performance of gold mining stocks. This index has seen significant gains in the last year, driven by the increase in gold prices and the performance of gold mining stocks. A notable example is the performance of the gold-related company, Royal Gold, which has seen a significant increase in its stock price in the last year, driven by the increase in gold prices and the company's strong financial performance. In conclusion, China's gold buying spree could trigger a $4,200 profit opportunity. To take advantage of this opportunity, consider diversifying your portfolio to include gold or other precious metals. And if you're not interested in buying gold directly, consider alternative investment opportunities like gold mining stocks or gold-related ETFs. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about gold investing, hit subscribe. I break down one of these every week. Take the first step towards protecting your portfolio and potentially profiting from the gold market's upside by diversifying your investments today. Specifically, consider allocating 5% of your portfolio to gold or other precious metals, and review your portfolio regularly to ensure it remains aligned with your investment goals.